Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. I apologize for the couple of minute delay for getting started, but let's go ahead and jump right into it. Last week, we continued to have equities move forward with regards to higher on the major indices. And I would say the big event this week that we have on our calendar is really the job reports number that come out at the end of the month. I'm sorry, at the end of the week. The last couple of job reports have driven a fair amount of volatility in the markets. So this jobs report that come out on Friday with the unemployment number could very much also be a driver of volatility here at the end of this week. We do have quite a bit of economic data with regards to labor coming out both tomorrow and Thursday. JOLTS data on Wednesday, jobless claims on Thursday. That can also have an impact here on what we can expect to see of the September labor numbers. We'll continue to monitor that. But in the meantime, you have the S&P 500 marching on to new all-time highs. Those highs so far have been confirmed by momentums, providing a fairly positive signal for the S&P 500 reaching new all-time highs. You do have the NASDAQ 100, which last week couldn't quite close above recent highs that, as of yesterday, started to see some strength here, which really puts the all-time highs into play here on the NASDAQ 100, but NASDAQ overall lagging behind the S&P 500. You have the Russell 2000 that also lags behind, but is also now within spitting distance of the all-time highs, around 225. Showing a little bit of strength here relative to the S&P 500, and probably, arguably more importantly than anything else, the equal weight S&P 500 index making new all-time highs and actually outperforming the market cap weighted S&P 500, showing us that not only are the markets moving higher, that there's actually a fair amount of participation on this move higher, which is, again, overall a positive here for equities. So looking at the equity markets, things look quite positive across the board when we look at the major indices. We've been talking about the fact that growth has outperformed value for a long time. But over the last 3 months or so, we really have continued to see value outperform growth. At the moment, value still is to some degree outperforming growth. We'll see if this can continue going forward. There are some slowdowns in terms of the outperformance here for value versus growth. We've kind of been sideways here largely for the last couple of months, but we continue to make a series of lower highs and lower lows on this particular chart, and that is worth understanding as you're thinking about equities and kind of which side of or what factor of within equities is currently performing. If you look at commodities, we have seen gold and oil diverge quite a bit, and that has kind of led commodities to be in this sideways choppy motion that we're in. And we'll take a look at those charts for gold and oil to kind of help better understand the outlook of those two individual commodities. When we look at the high yield corporate bond market, we continue to see that rally here to new recent highs. This provides a bullish backdrop, I would say, to equities, where the bond markets are pricing in a fair amount of calm relative to the credit risk concerns that are starting to bubble up. We've seen credit card delinquencies continue to rise here for multiple months in a row. We have had multiple bank CEOs, Jamie Dimon for JP Morgan. You also have Ally Finance, both providing kind of more deteriorating outlooks for the second half of 2024 and going into the first half of 2025, concerned around consumer credit and the strength of the US consumer. So I do think it's worth paying attention to some of those warning signs As we think about equities, reaching these all-time highs and how much further it can go, just make sure you kind of have that at the back of your mind, even though at the moment when we look at bonds, those concerns are not being reflected in bond prices just yet. So perhaps some of those concerns are a little overblown. One thing that I do think is worth pointing out here is that the VIX continues to move higher here. We're actually seeing the VIX at around just shy of 17%, despite the fact the S&P 500 is at new all-time highs, reflecting concerns over the next 30 days, perhaps concerns around the jobs report this week, that can lead to some market volatility, as we have seen over the past couple of months, very consistently after the first Friday of the month, which is when unemployment number comes out. That's when we saw an excess amount of market volatility. So markets at the moment anticipating a fair amount of volatility despite equities at all-time highs. And like I said, reflecting kind of a bit more fear and demanding more for buying protection here at this moment for equities, or at least on the S&P 500. You have the 10-year yield continue to moderate around that 3.73%. This sort of reflects a bit of a change here in terms of market expectations for rate cuts for the rest of this year. Markets are pricing in another 25 basis point cut. Another 75 basis point cut for the rest of the year. Devised into another 50 basis point cut and another 25 basis point cut. Even though the Fed, if you look at the language from Chairman Powell earlier this week, seems to reflect a more slower approach to rate cuts, kind of explaining that the economic picture is still strong, that he expects that there will potentially be only 225 basis point cuts for the rest of this year, effectively flying in the face of what markets are currently pricing in right now. But I do think bond investors are starting to come to terms with that a little bit with regards to what their expectations for rate cuts are for this year. But as you can see by rates, after that first 50 basis point cut, we've actually seen rates increase as a result of that announcement. And that really, again, reflects a more a shift in terms of the tone of the bond markets to reflect a less dovish policy than what the markets were pricing in just a few weeks ago. We see TLT give up some of the gains here over the past couple of weeks. We're now starting to test that 50-day moving average. If we break below that 50-day moving average, we could see yields rise as a result of that. So this is one that's worth paying attention to because bonds are now at kind of a pivotal support level, and we need those to hold in order for the bond rally to continue and for yields to continue to decline. Sharp rise in the dollar yesterday. After reaching this $100 support level here, a major support level that has been in place, kind of reflecting perhaps a bit of a change in terms of expectations for rate cuts. Like I said, taking a less dovish tone here, that has been a positive for the US dollar. And we have seen the dollar rally as a result of that. Our upside target here is around this 101.79 50-day moving average level. As we get to those levels, that is likely a better position or better price to be adding more bearish exposure here on the US dollar. And then looking at gold, we continue to see gold break out here above that 2450 level and continue to march on to 2750, which is our upside target on gold. We closed yesterday at about 2660 or so about $90 short of the 2750 high target that we have here for gold. On the flip side, you have oil making new relative lows, as you can see, settled yesterday at 68.17, near the lows of the year, reflecting what is weaker demand, despite all of the escalation of tensions in the Middle East. We continue to see oil continue to tumble, and that really reflects the market's concern around a lack of demand. And what's likely is going to be needed is a reduction in supply by OPEC nations in order to kind of bring oil to a more stable footing at the moment. We don't have that yet, and the markets are reacting negatively to what is concerns around lack of demand, yet supply remains fairly robust here at the moment. So looking at kind of the sectors, I think technology is certainly one of the sectors to pay attention to here right now. We've seen technology underperform the S&P 500 for quite a few weeks, starting to show a little bit of outperformance here over the past week or so. And we'll take a drill down into semiconductors here in a minute, but we are starting to see technology start to show some early signs of renewal in terms of its overall strength, aligning with consumer discretionary. Consumer discretionary has seen a fair amount of outperformance here over the past couple of weeks after breaking out from its recent highs above 195 here to the upside. Consumer discretionary, one of the leading sectors in terms of strength here right now. Communications, same thing, breaking out to new relative highs, both on an absolute and relative chart to the S&P 500, confirming those new highs with a higher high in terms of momentum. So we've really seen a fair amount of exposure being pushed into communications at the moment. On the flip side, financials over the past couple of weeks have traded nothing but kind of sideways to slightly down, and what that reflects is a more poor relative performance to the S&P 500. Financials earlier in the summer had been one of the best performing sectors, have at the moment slowly giving up some of those gains. We'll see if those gains can come back to life here over the next couple of weeks. But at the moment, financials seeing some rotation out of that particular sector. Look at healthcare. Healthcare, also another sector that has started to lose quite a bit of ground here, providing some defense here throughout the summer, but so far giving up most of those gains back here in just the last few weeks. On the flip side, On the flip side, if you look at materials, we continue to see materials outperform here, breaking out to those new highs, outperforming relative to both the S&P 500 for materials and industrials. And lastly, looking at home builders, we have continued to see home builders outperforming the S&P 500 off to new recent highs. And semiconductors, we have seen semiconductors also start coming back to life here a little bit. One thing to note is that semiconductors has not broken out above recent highs, and this is at risk of further downside here. So this is one that we are still continuing to pay attention to, because at the moment, semiconductors have not given us enough confidence to kind of resume a bullish trend. It very much is still range bound. So showing some early signs of outperformance, and we were referring to the fact that technology was starting to show some early signs of outperformance. But when we drill down into the semiconductor industry within technology, we actually see that that chart doesn't look as strong and still has the risk of potentially underperforming going forward. And that is a big risk that I think that I see to the technology sector coming back to life and being the dominant sector in terms of relative performance again at the moment. We don't quite see enough evidence for that. We really need to see semiconductors break out to new, above this trading range to kind of justify those types of views and outlooks. But at the moment, that's just not happening. just yet. So taking a look at some ideas here for the week, some of the new ones that we wanted to show you for this particular week. The first one here is Nike. Nike has seen some outperformance here recently on the back of the performance for China. We've seen the breakout here above $85 breaking out. There's a gap fill here at 92.5. That would be your first upside target to fill that gap. Then you have a secondary gap fill just shy of 100 here. That would be your second upside target for Nike. So showing that outperformance here and looking for that outperformance to potentially continue on. Another one to take a look at here is Eli Lilly. We know Eli Lilly has been the benefactor of some blockbuster drugs here over the past couple of years with the diabetes drugs that have now turned into weight loss drugs that have been very high in demand, but some of the charts are starting to show some signs of deterioration. We were continuing to see higher highs and higher lows, but we've started to make a series of lower highs and lower lows. Breaking below 900 for the first time at the end of last week, we've kind of started to rally back up towards those $900 level as resistance, and the risk is that this starts to roll over and retest previous lows around 750 or so on Eli Lilly, and the valuations on Eli Lilly remain extremely elevated, despite the fact that it is expected to grow significantly faster than its industry and is more profitable than the average stock in its industry. But it is trading at a valuation that is more than triple the average valuation of a pharmaceutical stock in its industry. So the risks are there from a valuation perspective, and the charts show some signs of cracks starting to form. Looking at that's the wrong one. Looking at NXPI, the semiconductor stock. Now, NXPI largely makes semiconductors for cars. So not, the type of stock that's going to benefit from the AI theme. As you can see, you can think of this as sort of almost a head and shoulders top that's starting to form here. But the things that we're continuing to see lower lows and lower highs, kind of a channel here to the downside. And our expectation is that we start to see some further downside here for NXPI. As you can see, that relative performance incredibly poor relative to the S&P 500. It trades at a discount relative to its industry. So from that perspective, it may look like a bargain, but I think if you look underneath the surface, expectations for car sales are only deteriorating further by the day. And we're seeing chip manufacturers like NXPI that are only expected to grow in single digits to begin with, continue to see potential slowdown for this overall industry. And then we also have just, the semiconductor industry as a whole not performing particularly well at the moment. And that's really where I see further downside risks for semiconductor stocks like NXPI. And lastly, 3M. This is a stock that has really just taken off here over the past year. This was a $70 stock less than a year ago, doubled to $140. And during that time, revenues didn't grow, earnings actually declined a little bit. So this is really where this is a stock that is kind of completely decoupled from its fundamentals and is trading at levels that, from a valuation perspective, from a technical perspective, that make less and less sense. And what you have here is a series of higher highs that is now being confirmed by higher highs in terms of momentum, leading us to believe that there is a higher probability of a check back here for this particular stock. It is overbought on both daily and weekly timeframes. It trades at a valuation that is very much in line with the industry, but if you look at the analysts' expectations, they're actually expecting revenue decline of about 7-8% over the next year or so. a company like this that has been around for nearly 100 years, clearly showing many signs of deterioration in terms of its overall business. It is expected to grow EPS. However, when revenue is declining by 7% a year, any form of EPS growth is only coming in from it's not coming in from growing the business. It's only coming from cutting expenses, and that's not a particularly good position to be in. Net margins are lower than its industry. It's trading at an evaluation that's still similar to the industry, despite the fact that it's expected to see negative revenue growth. And I think for those reasons, this is a stock that doesn't necessarily should be trading at its current valuation that is in line with the rest of the industry when it's actually in a far worse financial position than I think most of the companies in its industry. So for those reasons, I think the downside risks are there, especially when you look at the technical picture showing a fairly strong amount of exhaustion here from buyers. That leads me to believe that we could see a quick pullback here for 3M. So with that, those are some of the ideas I wanted to share with you here today on the back of our bigger macro outlook. Like I said, equities, if you look at the charts, look fairly positive, but we have some events coming up on the horizon that can add some volatility here to the markets, especially the labor numbers coming out at the end of this week. Make sure you pay attention to that. And I do think that if you look at kind of the big picture here, there are some cracks starting to show here, especially within technology. Look at semiconductors, look at healthcare, look at some of the more defensive sectors that are starting to underperform. Financials, leads me to believe that there are some downside risks here in the overall markets. So with that, I hope that gives you some insights into how to think about this upcoming week, some opportunities to look out for with some individual names. And I will see you guys here at during our Tuesday morning market outlook session next week. Thank you so much and have a great trading day.